This is a Zacks.com special report. Our special coverage on the stock market continues now, and in this part, Research Director Shiraz Mian is going to present his bullish strategy. Shiraz, we appreciate you taking the time to sit here with us in view of what's been going on in the markets here the last couple of days. But you've been quite skeptical for a few months now, and specifically of the consensus growth outlook for the second half of the year. You were consistently raising doubts that the soft run in the first half of the year may not be that temporary as a lot of people were saying that it was going to be. You feel vindicated by what's happened recently?
Yes, I am. And just as a way of clarification, I was not claiming that none of the softness in the first half was attributable to these temporary or transitory factors, Japan, weather, gasoline prices. But what I was disagreeing with was this idea or tendency in the market to lump everything on top of those factors. So yes, these elements had some role in slowing down the economy, but there were other structural forces at play underlying as well, which was keeping it down. So yes, it felt good when the folks came down to my view.
Well, what I've been reading from you recently suggests that you are not looking for a recession. In fact, you've said that in recent commentaries in the past day or so. But the overall news out there is kind of grim, as I'm sure you're aware. So where do you see any growth in the economy coming from?
That's true. The overall news flow is quite grim, and that's exactly what what all the markets, stocks, commodities, and the fixed income are reflecting as well. But I do see enough momentum in the underlying economy to keep the economy afloat. We may not have a very strong economic growth, but we are not heading into a recession either. And two main areas I would highlight where I see some growth. Number one is in the consumer spending side, which, as everybody knows, is the largest contributor to the GDP, accounting for almost 70%. And then second, corporate investments. And these two combined could be categorized as something like a core GDP. So on the consumer spending side, very briefly, in the second quarter, we had barely any growth. In fact, there was 0.1% growth, a sharp slowdown for what we saw in Q1 and throughout in the rest of this recovery. And part of that Q2 slowdown was because of temporary factors. Again, those temporary things.
Yeah.
The key element was that the soft purchases and spending on durable goods, on automobiles. Automobiles purchases were in the negative territory in Q2, and that dovetails with what we had seen in the Japan disaster-related supply chain disruptions in the auto sector in the U.S. That negative element is reversing already. We saw in the July light vehicle sales numbers that we had 750,000 more vehicles sold than was the average in June and May. So the consumer number in Q3 should go back to the average that we had been seeing in the preceding quarters, and that should give us a growth number that is better than what we saw in the second quarter. So overall, there is relatively more momentum getting into the third quarter from the second quarter than the headline data would tend to suggest.
Well, what about those disappointing July ISM numbers?
Very good point. The ISM numbers were definitely disappointing, and that's a fair point. But in order to get a good handle on what the ISM is telling us, you have to look back. Remember that the ISM, particularly on the manufacturing side, peaked way back in February. And from that point onwards, it has been kind of sideways to down. But even if we look at the weak July ISM number, it's still in expansionary territory. And I'm not asking for a 3% plus GDP growth rate. And ISM I'm reading that is in the 50 plus, 51, 52 kind of territory is consistent with GDP growth rate that is in the 2% region. We see that in the factory orders numbers. We see that in corporate capital investments on equipment and software. Those numbers have consistently remained positive. Even in the dismal first half of GDP numbers, we see that corporate balance sheets are in extremely good shape. So when you combine all these elements and add that to the relatively positive outlook for consumer, add to that the strong payroll numbers that we got in July, then the outlook for the economy is not as bad as some of the recent data may be suggesting. Now, granted, it's not a 3% plus GDP growth rate, but it's not a recession either.
So allow me to be difficult for just a short time longer. In your outlook, the economy avoids a recession, but the growth rates are relatively on the low side.
That's right.
Right? Am I right so far?
That's right.
So how is that a bullish case?
Very good point. Two main reasons for that. Number one, what the market's been telling us over the last 2 weeks or so is an outlook that is significantly more grimmer, if there's such a word, than what I'm talking about. The market is effectively pricing in an outright recession, and I'm asking about and providing an outlook for positive GDP growth rate, which is in the vicinity of 1.5% to 2.5%. Now, and that takes me to the second reason why this outlook is the bullish outlook. Mm-hmm. You don't need a 3% plus GDP growth rate to generate positive returns in the stock market. If you look back in history, there are as many instances where you have had strong stock market returns in a 2% GDP growth rate environment as there are in a 3+%. So it is not the end of the world. The economy may not be growing at a 3% plus growth rate in the coming quarters, but that is not the end of the world. You don't need to run for the hills and take cover. You can generate strong returns in this environment as well.
All right, now that we have your market outlook, tell us a little bit about how you would implement it, if you would. How should investors be investing here if they agree with your bullish market outlook?
I have a fairly straightforward, conventional outlook for how the folks should be investing. One of the key problems that we all face is that when we go through a downturn like what we saw in the last few days, we are so shell-shocked that the loss on the previous trade forces us to make a wrong decision going forward. I'm asking folks to have a diversified portfolio, have exposure to all the key sectors. You don't necessarily need to take cover in healthcare and staples and utilities, though some exposure to those sectors and the dividends that those sectors provide you would be also useful. Don't be afraid of growth and technology stocks either. There's nothing wrong with Apple now the way it was 2 or 3 weeks ago. Google is very good. Intel is very good. Don't be shy of getting exposure to some of the cyclical names too. I will be hesitant to dip into energy and basic materials at this stage, but there's nothing wrong with some of the leading names in the industrial and manufacturing group, names like Cummins, for example, Chicago Bridge and Iron, Eaton Corp. So I'm asking folks to create a diversified portfolio with a bias towards large cap, looking for companies that are leaders in their respective spaces, hopefully, preferably pay a dividend, and if they keep a disciplined approach of how they pick each of these stocks, they will look like geniuses in another 2 weeks. We are very close to the bottom of all the panicky sell-off that was going on.
All right, interesting outlook from you. We appreciate your time. And so there you have Shiraz's bullish outlook. Be sure to watch our other videos, the other 2 parts in this special series on the bearish and the balanced strategies, and then determine which one suits you. Now, if it's Shiraz that sounds like a strategy that's right for you, then continue to get his insights through the Zacks Premium service. That's available at zacks.com/premium. Or you can follow all of our experts that you're going to hear from in this series and their strategies with Zacks Ultimate. And you can learn more about that at zacks.com/ultimate with Shiraz Mian. I'm Terry Ruffalo.